they're not talking about it nearly as much as they should. It's a much bigger story than they realize. They have no idea why gold is going up, what it signifies, or why people should be worried about what this potentially means, that gold is at this price and going higher. So I think there's not a lot of coverage to make me nervous that, oh, maybe it's too popular and I should sell. And I think as gold moves up a little bit more, 4,200, 4,300, they may not even talk about it again until it's at 5,000, right? Because it's not like the main thing that they're discussing. Maybe when it's 10,000, they'll start focusing on it more on a daily basis.
PeterSchiff is one of the best-known gold bugs, that is, advocates for gold as a store of value against inflation, currency depreciation, and systemic risk. He frequently argues that fiat currencies, especially the US dollar, are inherently vulnerable to decline due to excessive debt, monetary expansion, and the printing of money. From his perspective, gold doesn't so much go up as currencies go down. The rising gold price is a reflection of the falling value of paper money. In his framework, reaching levels like $10,000 per ounce or beyond is not a speculative bubble, but a natural consequence of deep and persistent monetary decay. One of Schiff's arguments for a possible move toward $10,000 or even more hinges on sustained inflation and the inability, or unwillingness, of central banks to restrain money supply growth. If inflation remains entrenched and real interest rates, adjusted for inflation, stay negative or weak, then the purchasing power of the dollar may erode faster than many expect. Under such conditions, investors and institutions may increasingly turn to hard assets like gold as a hedge. Schiff often contends that once a tipping point is reached, gold's momentum could feed on itself. Rising gold prices trigger more demand, which pushes prices further upward. Another pillar of his view is the scale and persistence of U.S. government debt, combined with rising interest obligations. As the national debt grows, more government resources are channeled towards servicing debt rather than productive investments. Schiff warns that the government may resort to monetization, for example implicit or explicit money printing, to manage obligations. That could further weaken the dollar, reinforcing the trend toward gold as a refuge. In that scenario, he would see $10,000, or higher, as not an outlier, but a possible milestone in a multi-decade revaluation of gold against fiat. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Normally, a futures contract would be above the spot for something like gold, because if you don't have to pay for your gold for a few more months, there's a value of money, a time value. And so normally, if I don't have to pay for my gold till December, I get a loan for a couple of months. That means that gold is more expensive if I'm gonna keep my cash and not give the seller the money until December. But right now, you have a situation where buying silver today is more expensive than buying it for delivery in December. And that happens when there's a big demand for silver right now. People can't wait till December. They got to get it right now. And normally, I just assume I'll buy it in December, wait a couple of months. If I get it cheaper, it's the same thing. I'm not going to use it up. But it means there's some demand right now for physical. But also, I think what might be happening, there's a lot of shorts that have historically been around the silver market. And to the extent that the shorts are trying to lean on the price, they're doing it in the futures market. So maybe the shorts are trying to push the price down by selling futures, but it's not working because there's so much physical demand right now for the actual commodity where the buyers can't wait till December. And so I think that's really a sign that you're going to see some disruptions in the market. I think ultimately the shorts are losing control of this market. And I think what's going to happen is serious buyers who want silver but can wait a couple of months, what they're going to do is they're going to say, well, instead of buying silver now, I'll just buy futures contracts and I'll just take delivery in December. I don't need the silver. I'm not like going to, I'm not using it to make batteries or something. I just want it as an investment. So I'll just wait to get it a couple of months. That could cause a big problem because that could mean that a lot of people who are buying these future contracts are not going to just, close them out when the contract, comes up. They're going to send in a request for delivery. And that means the short, whoever's on the other side of that contract, is going to get notified by the exchange that they need to deliver a bar of silver, or how many bars, maybe a bunch of bars, depending how many contracts they're short, which means now that futures guy has got to go into the physical market and buy the silver because he doesn't have it. I mean, unless he's he's a mine and was hedging. But most of the sellers in the futures contracts are just speculators betting the price is going to go down. They don't actually have the silver, but if they have to deliver it, they got to go out and buy it. And now that increases demand in the cash market because now you have all these futures traders that need to buy silver. So look, this thing could explode. We could have a massive short covering rally because if you don't want to deliver, the only way out is to buy yourself out of your short. But of course, somebody's going to get stuck with the delivery notice because everybody who has a futures contract has the right to take delivery. Well, I mean, personally, we've seen an uptick in business, but I mean, nothing, spectacular. And of course, it's coming from a very low level. There hasn't been a lot of interest. The best year that we had at Schiff Gold since I've owned it or been involved was 2020, was the COVID year. And so a lot of people were like rushing to buy gold and silver during COVID, especially the early days. But we've got nothing like that now, even though from a price perspective, we've had a much bigger rally now. In fact, this is the biggest rally. We've had gold's up like 57% on the year. We haven't had a year this big since the 1970s. And there were several years in the 1970s where you had these big moves in gold, but we haven't had any since. And so you would imagine with, the best year since the 70s, we would be having a booming business, and we're not. And so that's a good sign that, this is still early. We haven't seen a big rush of retail buying, not even close. But yes, I think that if you watch the news now, there is some more coverage of gold compared to no coverage at all. So now, gold being at 4,000 was like, oh, okay, now it's a topic of conversation. But, they're not talking about it nearly as much as they should. It's a much bigger story than they realize. They have no idea why gold is going up, what it, signifies, or, why people should be worried about what this potentially means, that gold is at this price and going higher. So I think, there's not a lot of coverage to make me nervous that, maybe it's too popular and I should sell. And I think as gold moves up a little bit more, 4,200, 4,300, they may not even talk about it again until it's at 5,000, right? Because it's not like the main thing that they're discussing. Maybe when it's 10,000, they'll start focusing on it more on a daily basis. But even now, whenever they mention gold, they can't help but drag Bitcoin into the conversation. So gold doesn't even get like its own coverage. It has to share the spotlight every time with Bitcoin. So that'll change eventually as gold keeps going up and Bitcoin crashes, and the whole idea that it's digital gold, is exposed as a marketing gimmick. But no, I think we're still early days for retail. And in fact, Wall Street is now finally waking up to gold after, all these years of outperformance relative to stocks. Finally, they're starting to say, maybe our clients should have an exposure to gold. Morgan Stanley, I think the biggest example, saying the 60-40 portfolio should be 60-20-20, where your bond portfolio gets cut in half and you put the balance into gold. I think that is a major step in the right direction for Morgan Stanley. But it means a lot of buying is coming if brokerage clients all around the country are going to be selling half their bonds and buying gold.
However, Schiff doesn't usually present $10,000 as a guaranteed near-term target. Rather, he frames it as plausible under extreme but not impossible trajectories. For instance, in recent commentary, he has said gold is not going to stop at $10,000 and might even head toward $20,000 or more, driven by continued dollar weakness. He's essentially saying that $10,000 could be well within a broader upward path, not a ceiling. He also has suggested that political or policy shifts, for example under different U.S. administrations, could accelerate the process. In one past interview, he implied that gold might surge to $10,000 under a Harris administration. That said, there are important caveats and critiques to consider. For gold to actually reach $10,000, multiple reinforcing conditions would probably need to align: sustained high inflation, prolonged dollar weakness, low or negative real interest rates, loss of confidence in fiat systems, and possibly stress in the global financial system. Many analysts regard such a scenario as extreme and unlikely in the short to medium term. Moreover, markets often price in many expectations already, and sometimes extreme forecasts reflect asymmetrical thinking. The upside is dramatic if the scenario comes true, but the risk of disappointment is high.
You just took the words out of my mouth. I was going to say on steroids. Yeah, it's going to be similar to the 70s. And the similarity is that, so in 1971, right, we got the 70s started by going off the gold standard. And that basically opened up the floodgates for us to print more money and have bigger deficits because we no longer, had gold to discipline us, where we removed those shackles, right? So the government was free to be more reckless. And so the dollar lost a lot of value in the 70s as a result. That's why oil prices went from $3 a barrel to $40 a barrel. We tried to blame it on the OPEC, right? You guys are screwing us over, jacking up the oil price. But it was America that tried to screw over OPEC by paying them in paper instead of gold. So when we were giving them gold for their oil, we could get it for $3 a barrel. But when we wanted to give them fiat, it was $40 a barrel, right? It's not their fault that we tried to screw them over, but everything got more expensive. The dollar lost a lot of value. It was a big deal. In fact, the reason that so many women were working in the 80s and not in the 60s was because they had to get jobs in the 70s because their husbands' paychecks lost so much value because of all the money we printed that they couldn't pay the bills. So I think what's going to be similar about what we're about to experience is the second half of this. So when we went off the gold standard, the world never went off the dollar standard. They stayed with the dollar. They just marked it down, but they kept using it. Now they're going to, mark it out. I think now the world is going to say, okay, we're going off the dollar standard now. We should have done it 50 years ago, but we're going to do it now. And so that means that all these foreign central banks that have been holding dollars convert them into gold. And it also means that countries are no longer looking to accumulate trade surpluses with the United States in order to earn dollars. And if the world doesn't need dollars anymore, well, they don't need to buy our treasury bonds. They don't need to buy our mortgage-backed securities. And we're kind of on our own. And so that means that we're going to be staring at much higher prices for consumer goods because we're not going to get all these goods coming in from the rest of the world. It means we're looking at much higher interest rates because if we want to borrow money, we're not going to get it from the rest of the world. We're going to have to borrow it from other Americans. And most of us are broke. We're all borrowing. We can't borrow from each other. We need to borrow from China because they're the ones that save half their income. Americans spend all their income and then some.
Right.
So there's nothing left over. So look, this could be a rude awakening, but I think the dollar is going to see an even bigger decline now than during the 70s. I don't know how long it's going to take, but it was about a 2/3 decline. But I think the gold price could have a similar trajectory. Gold went from 35 to 850. Do the math on that percentage gain.
Yeah.
But I mean, we're just getting started at $4,000 gold. Look, we're going to continue to see deflation in terms of gold, right? Gold is real money.
Good answer. Go ahead.
And that's been going on. Look, the Dow Jones in 1999 was worth 45 ounces of gold at its peak. Today it's worth 11. That's a 75% decline in 26 years. That's pretty big deflation. But you wouldn't know it because in fiat dollars, the Dow has gone up fourfold.
Right.
But if you look at it in real terms, in real money, it's gone down a lot, and it's going to continue. And I think the same thing is going to happen for houses. I mean, housing prices have collapsed in terms of gold, right? The a number of ounces of gold that you need to buy a house. I haven't done the math. Houses may be the cheapest they've ever been.
Relative gold, right?
But, when people used to buy homes in this country, they used to pay for them with gold. When we were on a gold standard, gold was how we bought houses. That's how they were priced. So everything is going to get cheaper. But the problem is when you're in a fiat system where, in theory, they could just, rain money down, right? They can put as many zeros as they want on the bills. They can make sure the prices go up,
Got it.
even as the real value of whatever they're pricing goes down. So I don't think we're going to have deflation the way most people would think about it, where, stuff that costs, $100 today is going to cost me $90 tomorrow. No, it's going to cost you $200 tomorrow. But the problem is those dollars are going to be worth a lot less. So, in terms of gold and silver, yes, whatever you want to buy, if you have gold or silver today and you want to buy something in a year or 2 years or 3 years or 5 years, you won't need as much of your gold. You won't have to get rid of as much as your gold to buy whatever it is that you need.
By the early 1930s, PeterSchiff's long-term thesis on gold could finally play out on a historic scale. The foundation of his argument that massive debt, endless fiscal deficits, and central bank money creation will destroy confidence in fiat currencies appears increasingly plausible as U.S. debt surpasses $40 trillion and interest payments consume a record share of the federal budget. The U.S. dollar, once the unchallenged reserve currency, may begin losing its status as more nations trade oil, technology, and commodities in alternative currencies. As global demand for the dollar declines, gold's appeal as a neutral, borderless store of value will intensify. Between 2026 and 2030, Schiff's scenario envisions several reinforcing shocks: persistent inflation despite rate hikes, rising geopolitical instability, and a widening wealth gap driven by asset inflation. Central banks, particularly in emerging economies, would likely accelerate their gold accumulation to reduce dependence on the dollar system. By that time, annual gold purchases by central banks could exceed 2,000 tons, doubling current trends. Retail investors, facing declining confidence in digital assets and fiat savings, might follow, creating a feedback loop of rising demand and constrained supply. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.